Hi, I'm Anton Stetner. I'm going to hang out again with my amazing friend, Parker Stiles. And today we want to talk about this idea of scaling your real estate portfolio. When should you scale? How do you know to scale? What are numbers? This is the conundrum that every investor goes through as they start to build equity, as they start to build cash flow. What is my end goal and where am I going? So, Parker, break down for me real quick, where are you at? What have you been doing? And then, tell me where we're at today and then what you're kind of thinking, hey, this is where I want to go.
Yeah, so I've been scaling a rental portfolio and really let me back up. I have not I've been slowly building a rental portfolio as I've been flipping. I learned to rehab first. I kind of backwards got into wholesaling. And then as I'd flip a couple and I'd buy a rental. I'd flip a couple more and I'd buy another rental, and then slowly started to pick up some more and learned about creative financing. Started to sell some properties on owner financing, or quote unquote creating a note, versus you have buying a note and then creating a note. I would buy a property cash and then I would resell that property at a premium, but on owner financing, I'd collect a down payment and then get monthly payments over time. And that just, I continue to build things that would give cash flow. I would create cash from my flipping machine. We started going into syndications, started doing partnerships with other commercial deals like triple net leases, self-storage value add buildings. And so I've kind of spread out in a lot of different buckets, but my main center, or my foundation, so to speak, for the last decade really has been flipping properties, with the majority of those flips being wholesales. And then we, cherry pick for the best opportunities to wholesale, the best opportunities to do the full rehab, if that makes sense. And then investing that cash into passive streams. I think I understood early on from another coach that flipping and making hundreds of thousands, if not more, a year, at the end of the day, it's cool. I make my own schedule. I work way more than I did with my 9 to 5, but it's still a job. Yeah. You start over at zero at the beginning of every new month. There's no compounding. And so that's why I haven't amassed a 100+ unit portfolio. I've kind of done a slower organic growth with a larger amount of equity in my properties. And now you and I have started this discussion because I feel that it may be time to transition from those stepping stone investments into a larger form that might have additional positives, like more bonus depreciation, bonus depreciation, more appreciation. When I ran the numbers, more cash flow, all while having less noise. So that's kind of the reason why we're getting together, and thought it would be valuable to talk about this.
This is something that's so valuable for all of our listeners, our regular subscribers. If you're not, hit the subscribe button, hit the like button. And Parker's contact information, of course, will be below in the show notes. But what I want to get to that was so brilliant. One of the reasons to scale is this idea of reducing noise, of increasing cash flow, of getting more appreciation, getting more depreciation. And now with the Trump administration, Trump getting reelected, I think we can expect the CARES Act 2 to come out and bonus depreciation to go back to 100%. So I think we're actually really set up for an amazing 2025, a good 2026, but I think a lot of these benefits aren't going to massively show up until 2027 or 2028, later on in his presidency. So,
but Parker, you and I reaping the benefits of that, exactly what you just said, starts today. It starts by putting the reps in and getting to that point.
Yeah, and so tell me where we're at today. Let's go through some of the properties. What do you have? What's the cash flow look like? And why are you considering scaling them, today?
So in my particular rental portfolio, it's about 15 units or so, and it produces some nice cash flow because there's a lot of equity in those. We don't have a lot of debt service payments, which is nice. And by the way, this is simply the rentals that I'm talking about, because the rentals is what has more of the noise. Not discussing notes or other, royalty passive plays, because again, our whole discussion here, Anton, was like, how do we go multiply cash flow in areas that how do we make more by doing less? Right. That's simply what I'd say that. And so, 15 doors, my thought was, we've always been taught to buy and hold forever. Right. Like that's what the book says. I got started with Rich Dad, Poor Dad. A lot of people got started with Rich Dad, Poor Dad. It's the understanding of like, buy the house and you buy it with the intention to sell it. No, you buy it with the intention of never selling it, because real estate with enough time always goes up, is what they say. And so it's tough because we've had that ingrained into our head, but I don't think that's necessarily the best truth. I think it can be a truth. And I don't think that you would go wrong by doing that. But I believe that there are times where you can use those initial assets that you use to grow your wealth as a stepping stone to catapult up into something bigger. And that can be done in, certain times in the market. It can be done during certain debt cycles of those, assets that you have, and the ratio of debt to equity, how that equity is performing. There's different metrics that I've started to look at my portfolio with that are telling me to do the things that all the books told me not to do in the beginning.
Bingo. So the idea here, everyone, is sometimes you have to violate conventional wisdom if you want to grow massive wealth, or if you want to grow a massive portfolio. If you want to be different, so think of life as like this bell curve. If you want to be different, and then there's the bell curve, you've got to be one of the extremes at the edges of the curve there. So you're going to have to think differently. You're going to have to act differently. You're going to have to do different. And that's what this conversation is about. So Parker, as you're looking at your rental portfolio, what metric are you looking at that's, really starting to strike home? Is it cash flow, cash on cash, return on equity, loan to value? What's causing this? Like, I need to scale this up now because I'm missing out on opportunity.
Yeah. And I don't want to misguide with like scale. Like, I'm always trying to scale, and I know where you're going with that, but I think it's like repurpose almost with this particular move. I think acquiring right now during what we're going to go into the next, 4 plus or minus years. I think now is the time to acquire properties. I don't mean buy stuff that doesn't cash flow or make dumb purchases, but if you can get your hands on it and you can get private money, or you can, get in there with a DSCR and maybe squeak away with a couple $100 a month in net cash flow, knowing that it's going to be good on the other end, I think we're going to be able to ride a cool wave here coming up. But what I'm trying to do is like trade my surfboard out for a bigger board, a freshly waxed board, a board that's going to glide. So, compare a regular surfboard to a board on a foil. That's what I'm trying to make the conversion to right now. And that would be leveling up to a commercial assets, basically. So to answer your question, my cash from cash returns are all double digits. And that's why I haven't done anything. Yeah. It's because I was looking at cash flow. I was looking at how much, how little money we had in the deal, respectively, how much they've appreciated in comparison to what I had. And then I'm leveraging that equity with lines of credit, revolving lines, things like that, that I'm using that other cash for my hard money lending business, to do our flips, et cetera, et cetera. But return on equity was really one that stood out and started yelling at me after a few masterminds that, we attended together, and, some conversations with mentors of maybe it's time to level up. So return on equity, when I went in and I have this, elaborate Excel spreadsheet of all of these different properties and all of the factors across the board. There's like 20 or 30, columns that we're looking at. And one of the main ones being return on equity. And over time, that number gets worse and worse and worse because the properties continue to appreciate. And Also, rent does not increase in a proportionate ratio. The rental rates are not increasing at the rate in which your equity or the property value and your debt paid, right? You're going down and it's going up, and it's creating this void, which makes a lower return on your equity. So when I was looking at the average, I mean, I was looking at a lot of 4%ers.
Wow.
And so I asked myself, can I do? Am I confident that I can go make more than 4% on my money? Yes, I'm very confident I can triple that. So why am I holding rentals that are producing great cash on cash returns, but poor return on equity? And what can I do to improve that?
And so then it's almost like, how do you reposition the asset to then create a new cycle for cash on cash, for rent growth, for appreciation, and return on equity?
Exactly.
I love it. So everyone, this is kind of a semi-nerdy conversation, but I want you to really consider the wisdom here. As your loan to value keeps going down, if you are still in the accumulation phase, which is going to be the majority of people, unless you're in the latter stages of your life, when you go into debt pay down, if you're still in accumulation, what happens to real estate investors is they get lazy, they get comfortable, and they stop pushing really hard. And so that equity keeps rising. But what that's doing is it's driving one of your return metrics down, even though on other metrics like cash on cash, you still look like you're winning. That's the crazy thing. Give us an exact example of a number. Where are you at today? And then which properties or group of properties are you thinking about repositioning, and what would that look like?
Yeah, I was going to share my spreadsheet really fast if you think that would be valuable to do.
Absolutely. Let's go through that, sir.
So this is my dashboard, so to speak, for all of my passive income, but we're just going to focus on rentals. I kind of have them split up into tabs, royalties, notes, rentals, etc. So as soon as I get to the share screen, passive income, boom. So you'll see here now, this is kind of like the property is going down. We've got everything from the county to how they're titled, the mortgage that's being held, blanks are free and clear, what type of mortgage, the original face value, what the estimated, pay down value would be, purchase date, repairs that we did initially to get them cash flowing. We'll come in here and update, approximate values, approximate equity, cash in the deal, whether they've been cost segregated or not for depreciation, bonus depreciation purposes. Check this out. Return on equity. Look at this average, 4.24, average cash on cash, 16%. So we'll continue talking about that. Rent, loan constant is another way to look at these properties, taxes and, insurance, HOA, all of these things. So this has everything in one dashboard for us to be able to see. And you can kind of look at your portfolio and find out very quickly where the dogs are and which ones you might want to keep. So there's 4 or so in there that I probably won't sell. And we just picked up another 3 that, we're going to get producing. And I may only hold those for a couple years because of this wave, like I mentioned, but I do want to roll this stuff into a larger asset. So when I looked at cash flow, that was another thing that we were looking at. They're producing net a little under $5,000 a month. This is after accounting for, a month of vacancy, a month of expenses, true property taxes, true insurance costs, and then whatever's any debt service that's on that. And then we have that true net number being auto distributed every month to our war chest account, across those different properties. Yeah. And that's it's a little under $5,000 a month. When I ran numbers on just buying a commercial property, I own some triple net, smaller percentages of some triple net lease properties, and have gotten to experience how that works. The massive tax strategies that you can have from those type of properties when you're leveraging these larger purchase prices, and also how much more quiet they are. If you're not familiar, a triple net lease means the tenant has the responsibility of almost everything in the lease. They're paying property taxes. They're paying insurance. If the roof leaks, it's on the tenant. It's not on you. So it's not a standard, lease agreement like your traditional rental property would be. So say we trade up, say I pull out conservatively around $1.5 million of equity in these properties, and I want to go buy a property at a 10 cap. Okay. All cash. You can, you're probably going to fall somewhere between an 8 and a 12 cap for, depending on the area, depending on the quality of the tenant. If you're looking at a 15-year corporate guaranteed lease, you're probably not going to get a 12 cap, or maybe not even double digits, but you can still get in there, find some value add plays and get your double digit cap rate. Well, at a 10 cap, that'd be bringing in about almost $12,000 of cash flow. Now, compared to the $5,000, that's like $7,000 more a month of cash flow. And how many tenants are there? You could have a couple tenants maybe within this commercial building, but it's not, it's not 15 houses with, 18 doors and 38 toilets and all the multiples across the board, and a tenant that's expecting you to do everything, fix everything, all the traditional rental property stuff. So that's about $90,000 more ish a year, which is kind of astounding to me, of like, that's what I'm giving up by staying in the seat that I'm in right now. Yes, when you sell, there'd be some taxes, there'd be some recapture. Like, I'm not trying to get all into the weeds with it, but overall, that seems like a smarter play. And that's kind of what we're discussing. And I'll pause there for a minute. And the next, I want to talk about if you leverage that decision.
Well, I mean, that's massive. So what Parker's saying is, if I look at my equity and I simply reposition the equity and get into a high cap rate situation, I can lower my noise, can lower my problems, increase my cash flow. And then are you saying just pay cash for it? Or what happens if then we bring in debt? Or what happens if we bring in value add? Because what you're talking about is a good deal. And this is how you can take a good deal and turn into a great deal and start creating this exponential growth curve.
100%. So I ran a couple numbers and said, if we leverage that 1.5 million, I actually used 1.4. So let's get a little bit more accurate numbers here. If we leverage that 1.4 and put 30% down on the note. Now I did not get any loan estimates or quotes for this. I've not taken that step yet. I don't have a building, in due diligence that I'm looking at. This is all kind of like up in the air discussing. So don't quote me on the numbers exactly, but I tried to be somewhat conservative. 30% down, we'd probably get roughly a $4.5 million building with those numbers, with a 70% loan to value. We could be getting, if we use the same 10% cap rate, right? Which would be $450,000 a year of gross, NOI. I guess not just NOI. Monthly payments on a 70% loan is going to run you $3,150 a month. And I calculated that at a 25-year AM and a 6.5% interest rate.
Yep.
So there's going to be some flux there, obviously, depending on the borrower and the down payment, et cetera. But that would be 6.5 interest rate would be, so that'd be 21,000. I said that wrong. The 3.15, that was the loan amount.
Yep,
$3.15 million loan on a 25-year AM and a 6.5% interest rate. That's $21,000 a month would be your payment. So
just PI.
Right. That's the first kind of gut check of someone that's in this position and is trying to get up to that next seat. Is you've got to be comfortable writing checks like that. That's
big boy checks.
It's a different
big girl
game.
checks.
Yeah, exactly. But if we were in that seat, your rent from that building should be about $37,500 a month using these numbers. Okay. So that's a net of about 16 grand every 30 days.
Yeah. Now, one thing I want to add in for the listener who is going to miss this nuance, when you're doing a residential rental or a single family or a duplex or a fourplex, you're paying the taxes, the insurance. What Parker is referring to when he moves into this commercial world and you end up with a triple net lease, the tenant is now paying the taxes and the insurance. So that is one of the reasons for this big jump in cash flow is he's lowering the noise, but he's also getting rid of the taxes and the insurance that's being passed right on to the tenant.
Right. And if you remember that initial cash flow of, the little under $5,000, that's about 11 grand more every month than we're currently making. And we go from, all of these tenants to one or a few, say you buy a little small shopping mall or whatever the asset is, a few tenants where the lease says that they take care of everything. And it's so much closer to mailbox money, which is what people call rental properties. And being a landlord for 6, 7, 8 years now, I can tell you it's not it's not mailbox. Well, I don't know. In tranches, there's periods of years where you don't hear from a tenant or a property for a couple of years, and then all of a sudden the roof comes falling in, right? So there's pros and cons with that. But when the tenant's responsible, think about selling a property on owner financing. That's mailbox money, right? Think about a oil and gas mineral rights. That's mailbox money. You're not doing anything to have that income come in. You are having to actively run a landlording business and take care of little issues here and there for rental properties. So this grows our income by over 6 figures a year with the exact same equity that we have already built. Again, stepping stone, right? And then this doesn't even go into that 3.5x is the ROI. And we're not even talking about going in and doing a cost sag or any of that other creative stuff.
So the simple movement in taking the equity and repositioning the equity into a larger asset, assuming you can get a good cap rate, good debt, and quality tenants, is 3xing Parker's portfolio. The thing that I want to talk about next is what happens if you found a value add, and then also what happens if you then cost seg it, because this is where instead of 3x, we go exponential, where maybe we're buying a building that's currently performing at a 6 cap. We put some money into it, and all of a sudden we get it performing at a 10 cap, and then we cost segregate it. And all of a sudden we're working in a different world. Walk me through that kind of idea, brother.
Yeah. So I'm a partnership where we're actually looking at a large triple net lease purchase building in Atlanta, Georgia, and it is a very large value add play. And some of that value is coming from leased out basement space, right? We're working with a group that might come in and do a self-storage in the city type play and a lot of unused basement space. There's a restaurant in this building that is being poorly utilized that is going to be maximized by this new restaurant owner that we're talking with. And so there's a purchase that's around a 9 cap that after these value add plays, it's actually in an area where you walk in, it's this beautiful atrium style ceilings. It's built a long time ago. That's part of the scary part of potential costs and stuff that could come up. But there's income that the current owners are getting from movie producers, and they will pay just for a day or a few days to come in and shoot a portion of their film in this, atrium area, just to add the flair. And that's another income producer for this. So it's an opportunity to go from like a 9 cap to potentially 14 or 15 cap, once bringing in this additional value add. So you talk about leveling up from the single family to the commercial. Then you talk about the forced appreciation and value add from increasing the cap rate. And then you go and, say you buy something and you got to throw $300,000 into it. You add all that up, you go pull out all the 5, 10, 15, et cetera, year that shorter term depreciation, and you rip it all out year one. Hopefully we go back to 100% next year. That if you are a real estate investor, a full-time real estate investor, and have a lot of other income that you need to offset, I mean, you could easily be paying $300,000 of taxes on your other business income. So say you use this cost seg, you wipe all that away. You just took that $300 you made here that you didn't have to pay Uncle Sam, and you got all your renovations done on your commercial property for free.
Exactly. So we're just going to play with some rough numbers here just so all of our listeners are on the same page. So this is basically a $5.5 million building got my calculator up here on the screen. And that $5.5 million building is producing around 495,000 in NOI right now. Whoops, I did that backwards. 495 divided by 5500. Okay, so it's
9 cap.
Yeah, so it's roughly producing at a 9 cap. So if we have 495,000 and they're going to put about 300 grand into this property, and we know that's going to bump the income by
there's a potential to bring in another 400,000 plus of income on this if done right, using all the other additional vacant spaces.
Wow. Okay, so we're going to add 400,000 in income to this. So that gives us 895,000. Then if we go 895,000 divided by the 9 cap that it's currently performing at, that gets you to a 9.944 building minus 550000. So they're forcing in $4.44 million in appreciation for 300 grand in renovations. This is what we're talking about. And then the idea is all of a sudden, if you've got a $10 million project and you're going to go through and cost segregate this is going to give you what, $1.5 million to a $2 million write-off?
Yeah, it would be probably enough to pass on to the next year and recoup some of it. plenty of write-off money, and however you wanted to allocate that, you could say you got your repairs paid for, or you didn't pay taxes for 1 plus however many years you had for your income. I want to say like this is a tricky deal, and there's some risk in this deal, and the sellers know that. They're actually now trying to retrade and grab a little bit more, because I think they're realizing how there's some things with Atlanta and the local area, and a lot of money is being poured into this particular section. I think they are realizing how good of a deal maybe it is, and they're trying to squeeze in a couple areas. But I want to say that like these deals aren't everywhere, but they are out there. You can definitely go put in $100,000, $200,000 and go increase a building's value by 25%. And what you were saying is take that increase and then divide it into today's cap rate that they're selling at a 9, but once we get it all performing and work out the get rid of some of the hair, improve some of the vacant spots, value add, eliminate some of the risks, then and then in a better market, right? Fast forward 2, 3, 4 years, if we're in a better market with lower interest rates, better leveraging abilities, you can divide that value by an 8 cap, a 7.5 cap. And then how much does, Anton, what is 7? I'll just do it right here on my calculator. If we added
I already did it, brother. I already did it. So if it at 895,000 in net operating income divided by an 8 cap, assuming better interest rates, better economy, that gets you an 11.187 or almost $11.2 million building. If it's a 7.5 cap, it becomes almost 12. It becomes 11.933, which is unbelievable.
That's what I love about the compounding effect of commercial and just the scale that it can get you by making these little tweaks. How many houses would I have to buy to work with these kind of numbers? And I'm not doing it all. This is not just my property. I mean, this is with partners and raise money, et cetera. So maybe you can't do it all on your own, but even if you're split between, a few different partners, it only takes a couple of these to create the massive wealth. And then when we do go, let's go back to the surfboard analogy. Wouldn't you rather ride this surfboard on the wave that we could be about to be going into appreciation wise, and how much of an exponential effect would it have on your overall cash flow and wealth, creation versus 20, 30, 40 houses?
Bingo. And then one thing I want to go back to is So do you plan on doing a 1031? Like, are you going to take, part of that portfolio in 1031? Are you going to pay some of the gains? Are you going to take 3 or 4 and then try to chop those up into commercial? What's the game plan moving forward for you to roll your portfolio?
Yeah, I think with the size of my portfolio being, about $1.5 million of equity once it's all said and done, I don't think I could tranche it up. And I mean, I could buy a couple, $1 or $2 million buildings. I'd rather get something more stable that's kind of in that higher purchase price. You're kind of in that sweet spot between like all the little deals, single family houses in the commercial world per se, and then like the private equity world that's scooping up the, $8+ million properties. I think there's a little sweet spot in there. I'd like to be in that $3 to $6 million range for a purchase. So I think I'm going to have to sell in tranches as tenants vacate, as they get improved. Yep. And I will pay some capture. I'll pay some capital gains tax on those buildings. But ideally, I could start at the beginning of a year. This may be 2025. And throughout a period of 12 months, I may be able to get the majority of them sold. Maybe I've got to sell a couple that are tenant occupied to investors versus reaping that full rip, getting them vacant and going owner occupied. But I'd rather not sell them all in one big tranche, because I think I'd have to sell it at too much of a discount, and I'd rather just pay some of the tax there. And even if I do pay the tax, it doesn't mean I can't mitigate some of it through some other plays that I'm doing, investment tax mitigation wise.
Brilliant, brother, man. Brilliant. So here's the thing I want all of the listeners to hear. Parker is willing to pay the taxes, willing to not take top dollar in order to create an easier asset to manage, to create a bigger asset, to create more opportunity for him and his family. And I think so often as investors, we get stuck on trying to just pinch every little penny out of the deal when time is money, speed is money, frustration is money. Because if I have to get all the tenants out, if I got to get them all perfect, there's a certain level of brain damage I have to go through. But if I'm just like, okay, I'm going to get rid of these properties in 2025. I'm going to do my best to maximize on them, but I'm not going to focus on having to squeeze every ounce out. That becomes a much easier transition to deal with.
I want to say that a different way because it's such a solid point that you're making. I've heard that Gary Keller is super cash heavy, right? Owner of or founder of Keller Williams, very cash heavy. All of us investors, we're like, how do we put money into assets to hold value or maintain, value through appreciation as fast as possible? And Gary has almost said, I'm not going to get into all these little deals. I understand what I believe is coming, and I'm sitting on hordes and hordes of cash. I've sold a lot of my assets and I'm waiting to pounce on the opportunity, because when the opportunities are heavy, you probably aren't going to have a lot of cash. Bingo. Unless you sold on purpose to be sitting on cash. And so that's just kind of another analogy of proving that point that, all of these little things that we're trying to, tweak this and get all the juice out of the squeeze. I think it can kind of hold us from the big moves sometimes. And you don't want to let that hold you back for too long.
I love it. This has been an amazing conversation. Parker, where are you out of again, and how can people get in touch with you, sir?
Yeah, social media, Parker Styles, Facebook, Instagram, TikTok, etc. We've got a hard money lending business, fast track funding that we're funding in the Carolinas and Georgia. If you're looking for any hard money loans for flips, coming into a rental to get it repurposed and rented for a refinance. And yeah, would love to reach out and talk with some people on social.
Thank you, brother, man. I appreciate your time.
Thanks, Anton.